I want to introduce Jim, who's going to be giving the presentation, our speaker today. Jim joined this group 4 years ago. This group is a little over 5 years old, so he is one of almost the earliest ones here. But Jim is always very entertaining in any kind of presentation he does, and I always look forward to when he's going to give his presentation. So Jim, take it away.
Thank you, Dave. I'm glad he introduced me as one of the earliest members here, not one of the oldest. I have the good fortune to have an 11-year-old nephew last night who provided me with the definition of an expert. An expert is a former drip under pressure. Thank you. And it was real important for us to stay up and play Monopoly until about 11 o'clock last night. So this morning I'm just going to paint some pictures with words, if I can. And I thought I would treat you all to a thrilling history of mortgage banking. I was born just before the end of World War II, 6 years after the mortgage banking industry was born in the United States. So I've seen pretty much the entire history of the mortgage banking industry. The mortgage banking industry, as we know it right now, started in 1934 with the formation of a good bank and a bad bank to take care of all the loans that had gone into foreclosure with the banks. The bad bank worked off the loans that were in default. All the good loans went to the good bank. That was the Federal Home Loan Bank, which became Freddie Mac ultimately, and Fannie Mae, and during the same period from 1934 to 1942, Fannie Mae and Freddie Mac were formed. FHA and VA came along shortly after that. The genesis of all of this was the idea that instead of having banks loan their own money, I mean, what a terrible, ridiculous concept that is, they would make loans, use those loans as collateral for some bond-like instruments called mortgage-backed securities, which could then be foisted off on pension funds, insurance companies, governments, and people like that who would buy these mortgage-backed securities. The money would come back from the mortgage-backed securities to the banks after they've sold those loans so that they could go out and sell more loans. And that's the way the business works today. Back at the end of the Depression, 1939, well, actually we were still pretty much deeply in the Depression in 1939. Banks were still lending. It was all private money. They were lending their own money. That is, the assets in the banks were at least funded by the deposits in the bank's assets, being loans, were funded by the deposits in the bank. So depositors, just like the good old days, Mr. Smith goes to Washington, the depositors' money was being loaned out to farmers and shopkeepers and things like that. You could get a loan. You could get a loan, you had to put about 50% down. You got a 10-year term. Interest rates were competitive because banks were actually competing for these loans. And at the time, interest rates were in the 4 or 5% range. Now today, it's very different because as a result of things that have happened over the course of the last few years, beginning with the crash in 2008, government has seen fit to come in and very tightly regulate every financial transaction, more so than ever has been the case. This regulation occurs under the aegis of an organization called the Consumer Financial Protection Bureau, which is funded through the Federal Reserve Bank, which many of you will not know is not actually a part of government. It's a private bank created in 1913. The head of the Consumer Financial Protection Bureau is a guy named Richard Condroy. Richard Condroy was appointed by the president, and he serves for life. Can't be impeached. It's a lifetime appointment. He has more tenure, in fact, than a Supreme Court justice who can be impeached. So now all of the decisions about every financial transaction in the United States are directed and regulated by this particular office, along with the other federal regulatory agencies that we already had. And what this agency has said is, this is the loan you will be able to get. You can't have a ratio where the sum of all of your monthly payments, car payments, student loan payments, and that house payment exceeds 43% of your income. I've made many loans in my life where that ratio was 65%, but at the end of the day, the person that I made that loan to still had about $6,000 a month left over for beer and donuts. You know, so that is a hard and fast ratio now to be a qualified mortgage, it's called. The other thing is you can't have a loan that has any, they call them special features, which means basically you get your choice of any color as long as it's black, to, you know, use Henry Ford's statement about this. So you can have a 30-year fixed rate loan, you can have a 20-year fixed rate loan, you can have a 15-year fixed rate loan, or a 10, or in some cases even 5. Under certain circumstances, you can have a mortgage where the interest rate's fixed for 5 years, after which time it adjusts every year. But if you do that, you have to qualify, remember that 43% ratio, on the premise that that loan could go to the sum of the initial interest rate, make it 2 3/4 today, to what it could be under the worst case in 5 years, make it 7 3/4. So you have to qualify at a higher rate than you would have to qualify for a 30-year fixed, 4 1/4 today. Now, the objective, of course, of all of this is to make sure that consumers are protected from predacious lenders and scrupulous people. But it has also affected the ability of people to be able to buy a home because of these very restrictive requirements. What's beginning to happen today is you can get a non-QM or non-qualified mortgage with, you know, 40% down, 10-year term, interest rate at 5 or 6. So we've really come full circle. And the people that are making these loans are hedge funds. They're finding that it's at less risk for them to invest in a mortgage like that than it is to invest in the stock market. And the yield is higher, and it's pretty much guaranteed. Certainly it's much higher yield than treasuries. I mean, a 10-year treasury bill today is 2.29%, I believe, when I got up this morning. Who knows what it is right now? So what's the point of all of this? The point of all of this is that we have now come to a place where you can still get a mortgage. You just have to fit in this little box. And if you want to get a mortgage, I'll help squeeze you into that little box so that you will be able to get one. Now, I had one more topic that I thought I would get into. How much time do we have, Dan?
Dave?
Yeah, you're fine.
Okay.
Politics?
What? Did you say the magic word? Was that apolitical enough, Dan? For
I think that was pretty apolitical. I don't
Okay.
think you strayed too far.
did I? No, I won't. So a lot of people really think that money, well, I mean, some people think it falls off trees, but in the case of the mortgage business, it's kind of a mystery where the money comes from, and I touched on this. But basically, it's possible, allegorically speaking, to be your own grandpa when it comes to mortgages. And what do I mean by that? Well, if I make a loan to Michelle, and it's an FHA loan because she wants to buy a house, and she thinks I'll do a good job for her, so I get to make the loan. That loan then gets sold to a lender. I'm a broker. I'm a marriage maker, a yenta. I just basically make these arrangements. The lender is going to take that mortgage, pool it with a couple of 100,000 other mortgages into a pool of mortgages, which they will then sell to one of the agencies I mentioned, Fannie Mae or Freddie Mac. Fannie Mae or Freddie Mac will then send that money back to the lender, who will then have more money to loan. Fannie Mae and Freddie Mac then take this pool of mortgages and they issue these mortgage-backed securities that I talked about. And in the case of an FHA loan, that's called a Ginnie Mae security, which stands for Government National Mortgage Association, or FHA and VA. Dan will then sell you a Ginnie Mae mutual fund, Michelle, which invests in Ginnie Mae mortgage-backed securities. So part of your investment goes to fund your own loan, which I think is kind of a magic circle of virtue, personally. Okay, any questions? Dan, I know you're biting your tongue too.
No, I think you explained it very well. Certainly mortgage-backed securities are a decent part of our business. Ginnie Maes are guaranteed by the government, where other mortgage-backed securities are backed by the full faith in credit, but not actually guaranteed by the government in certain instances. But yeah, I mean, we find in financial planning there are three types of good debt, three types of good leverage. One being real estate, one being education, and one being business. And the things they all have in common is they all appreciate. So right now, in historically low interest rates still, even though we're talking about them ticking up some, and they have started to, you know, it is, if you need to refinance, if you are looking to buy it, this is besides what the prices are in this area, this is a really good time to talk to Jim. And what I've used Jim for so many times in the past, even this week, is called him up as a resource. I needed a quote on creating a spreadsheet for a client of what a construction loan or percentage would look like. And not only he went above and beyond and called me back a second time and gave me some more advice. So Jim is not just here to get you a mortgage. He is here to be a resource for you and to go above and beyond. And he's done that for me countless times, and I appreciate it. So thank you.
Thank you. Yeah, so a drip put under pressure gets squeezed and squirted out, becomes an expert test.
What's the difference for a extremely great credit score versus a okay credit score?
Okay, credit scores. Range of credit scores is from 0, no credit score, for someone. I've got trust fund clients who've never had any credit at all. They just call the trust and they get a car or a house or something. Lovely folks that just didn't take the time to build credit. I've actually done loans for those people. No credit score, believe it or not, is better than a bad credit score.
Wait, no credit score is better than a bad credit score?
Exactly.
Okay.
Yeah. There are limitations on, like FHA and Fannie Mae have limitations on the minimum credit score that's acceptable under their guidelines. VA doesn't. But the range of credit scores is from 500 to 850. Typically, a credit score of 620 will get you a loan, even a conventional loan. But if you were 720, the difference in cost to you is 0.25% to the rate. So having a spotty credit history is really very expensive when it comes to any kind of a loan.
Even life insurance, it costs more for life insurance with bad credit.
Yeah. Yes.
I have a question regarding VA. Let's say that I have a VA, I can do a VA loan. So I buy a house, VA loan. In the course of several years, I sell my house, but it's they assume my loan.
Yes.
Okay. So now I don't have my VA available to me. Correct?
Under one circumstance. There's another where you would.
Okay, and then once that loan is clear, then can I then have, I can go out and purchase another?
Yeah, in fact, to expand on that just a bit, you're correct as far as you went. If the person who buys your home is also a vet and substitutes their eligibility for yours, you get your immediate full benefit back. If you bought a home back in 1970 for $60,000, which you could have done then, a nice home, and you have what's now a $48,000 VA loan on it, you can go buy another home using VA because your eligibility now, that's a code word for how much you can borrow, is so much greater than the part that you used up back in 1970. So there are several circumstances under which VA can use its benefits again and again.
Okay. Great.
Jim, what's the difference between the client who files a bankruptcy? Is it better to have a bankruptcy or a foreclosure?
Why choose? they're both, you know, they're both bad for your credit score. And you have to make a distinction between different types of bankruptcy. So it's Chapter 7 and 13, and as you well know, these folks gathered here might not have any experience with
But
it.
from a date of discharge, it's 2 years for a conventional loan after a bankruptcy?
No, for FHA. For conventional, it's more than that unless there were extenuating circumstances, like you were in the hospital for a year. Something, I mean, it has to be really a terrible, unforeseen, unpreventable circumstance. And the rules changed, and the rules are different too from foreclosure. So it used to be 7 years from your foreclosure before you could get a loan again, and it went to 5. FHA, you can now do 2. These new hedge fund programs, if the ink's dry on that discharge or that foreclosure, I can get you done. Because, I mean, when you think about it rationally, the worst is over, you know. You have people who do strategic bankruptcies and strategic foreclosures, high net worth people with high income. And they look at this, you know, $2.5 million house they bought in San Francisco that's now worth $125, $1.25 million, and they still owe $2 million on it. Some people will actually let that house go into foreclosure. But they're still making $30,000 a month, you know. So there is some rationality that's being returned to the lending industry, and that's the good news. Yes.
Say your papa was a Rolling Stone,
Yes.
and when he died, what did he leave you?
Where did he leave me? Hmm. I have no idea, but that's a very good question. Oh. I still remember that one. I love those
That fits right into
preschool.
All right.
Well, I'll leave you with this. I've been through 12 administrations in the White House, 2 of which were good.
There's this